So, Stan the Annuity Man, America's annuity agent. What kind of returns do fixed rate annuities offer and give and promise and all that yummy stuff? I'm America's annuity agent for a reason, and the reason is I only focus on the contractual guarantees of the policy. You own an annuity for what it will do, not what it might do. So when we talk about returns on annuities, it's different than when you talk about returns on investments like stocks, bonds, mutual funds, ETFs, crypto, whatever you want out there in the non-annuity world. Returns on fixed annuities should be contractual. That's what you're looking at. Returns on non-annuity assets, go for it. Knock yourself out. Hopefully in the bull market that we're in at the time of this taping, you're making lots of money by throwing the darts or having your professional dart thrower that you pay a fee for do it for you. But the question isn't a problem. The problem is annuity agents and advisors, they blur the line. So they're talking a lot of times about annuity returns that are non-guaranteed. Anyone that talks about annuity returns that are non-guaranteed, you need to go to the other side and just buy something that has real growth, because that is a too good to be true pitch. We're going to go over all of that so you can understand what you're hearing, seeing, what's being shown, and hopefully choose us for a rational contractual approach when looking at annuities for your portfolio. I'm going to do all of that after I take a sip of sugar-free Coke, because I got the sugars after this. Okay, so what kind of returns do fixed annuity contracts offer? Getting back to the sugars part, in the South where I'm from, they don't call it diabetes, they call it the sugars. You got the sugars, man. I got the pre-sugars, pre-diabetic. So even though I like if I was on death row, peach cobbler, man. That's what I'm going to do, peach cobbler. So what are the returns? Let's go through the types of fixed annuity contracts that are out there, one by one, okay? Multi-year guarantee annuities, the annuity industry version of a CD, multi-year guarantee annuity, acronym MIGA. You can see a live feed on my site specific to your state of residence. Returns on those are contractual, okay? Just like a CD, you lock in a specific interest rate for a specific period of time. 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7 year, 8 year, 9 year, and 10 year are available to lock in contractual. Now you can also choose whether you want to have the ability to take interest out or 10% of the contract out, or if you just want to lock and load and let it grow contractually tax deferred. You can put it in a Roth IRA, a non-IRA, savings checking account, or a traditional IRA. Works in all three. That's the return there. Now, this is when it gets a little fuzzy on the return side, but I'm getting ready to clarify it and make it very simple for you. There are 4 fixed annuity products that provide lifetime income. So solving for longevity risk. You're transferring risk to the annuity company to pay for as long as you're breathing and or on a respirator. Okay? So those products are SPIAs, single premium immediate annuities, DIAs, deferred income annuities, qualified longevity annuity contracts, those are QLACs, and then income riders that ride on top of a policy. Typically, that's an index annuity. We're going to talk about index annuities in a second. But the question is, what's the rate of return? What's the good return on a contract for a fixed annuity? Return for lifetime income is primarily based on your life expectancy or life expectancies if you set it up joint payment. All right? Interest rates play a secondary role. Interest rates play a secondary role. Interest rates play a secondary role, okay? So don't hit me with, well, I'm waiting on the new Fed chair and what are you? Stop. With lifetime income, it's about life expectancy. And right now, life expectancy tables are a bargain because AI is getting ready to change things and make our life expectancies longer, which means the payments will be, there'll be more payments, which means the payments will be lower. So it's a bargain right now. Doesn't mean you have to buy it right now, but you got to know that right now. So rates of return with like, what's my ROI on a lifetime income annuity, Stan the Annuity Man? I don't know that until you die. Or if it's joint, I don't know that until the second person dies. And we structure most of these policies, unless you tell us otherwise, so that 100% of the money goes to the beneficiaries if you die early in the policy. So throw out that crap thing you heard from your friend. Well, don't buy an annuity for lifetime income because if you die, money goes poof. No, your brain just went poof, friend. You're drinking too much, okay? You're losing too many brain cells. Most of the lifetime income stuff that we structure is lifetime income and with a backstop. Little League reference there, okay? So what's the return, Stan? I don't know that until you die. What's the rate of return, Stan? That's a numerical number on your life expectancy. There are sites out there that fraudulently put up like immediate annuities return of 7.3% or 8.2%. That's a numerical reflection of your life expectancy, player. That's not yield. They throw it up there to think you're thinking, well, I'm getting a 7.8%. No, you're not. With lifetime income, it's a combination of return of principal plus interest. That ain't yield, player. Yield is a MIGA. Don't touch the money, peel off the principal off the top. Lifetime income, combination of return of principal plus interest. That's not yield. So if you said to me, well, what's the payout on a $100,000 immediate annuity? Let's just say it's 7.3. I'm just pulling that, okay? Great. Does that mean it's yield? No. But you asked me, the question of this video was, what's the return? What type of returns am I going to get? With lifetime income, the return is it's going to pay you forever. Nobody yet has called me up and said, Stan, what's the rate of return on that Social Security lifetime payment I'm getting? Nobody does that, but yet you will go anal probe, sorry about that, Dr. C, that's a medical term, anal probe into the return on investment for an immediate annuity. Well, I need to know what that is. Well, do you know what that is for your pension or your Social Security? Well, no, that's different. No, it's not. You're either going to transfer the risk for lifetime income or you're not. If you're going to overanalyze it, then don't buy it. Which leads me to the indexed annuity side. This is where it gets weird, okay? Because in 1995, index annuities were put on the planet and introduced. I think first carrier was Keyport Life. For all of you who's going, yeah, I remember Keystone. Keystone's a beer, okay? It's a beer. It's not here anymore. I remember we used to get Keystone Light in college. It was like $1.99 a six-pack or something like that. That was before I stopped drinking. But the point is, in 1995, Keyport Life, that's when indexed annuities were introduced. Since that time, in the biggest raging bull market of all time, they've done exactly what they were designed to do. What's that, Stan? CD returns. What's that, Stan? CD returns. What's that, Stan? CD returns. So if anybody is out there promising, well, you can get 7, 9, 10, 12, 13, 8, I've seen 20, they're lying, okay? The blended rate of return is CD type returns. 4, 3, 4, maybe 5% if you're lucky. That doesn't mean it's bad. That means how it's sold is bad. And then they throw on the upfront bonus, which is candy for the stupid. There's no philanthropist annuity companies. It's just part of the overall contractual guarantee. Everything is easy to explain in the fixed world. From returns, MIGA, very easy. Lifetime income, the 4 products, very easy. Indexed annuities, sales pitch nonsense. If you buy the dreams, you're going to own the contractual realities. Period. End of story. Driving me crazy. We sell more than anybody because we attach income riders to them and then we completely ignore the indexed annuity product because you're buying the contractual guarantee, the income rider. So when you're looking at rate of return or returns of fixed products, it's very, very, very easy because we only look at the contractual guarantees of the policy. Where it gets fuzzy and nebulous and nuanced and crap and just nonsense is on the index back-tested return, hypothetical, theoretical, unicorn chasing the butterfly crap. It's a CD product and there's nothing wrong with that, okay? But if you think you're going to get more than that, you're what they call the sucker at the table in Las Vegas. No exceptions. Do me a favor, go to my site. I have a bunch of books. I got a book on all of these products. MIGA, DSPIA, QLAC, and income rider, and index annuity. That would be 6, Dr. C with the thumb. Owner's manuals. You can download for free. I wrote them. I've done a bunch of videos on them. You can schedule a call with me. You can email me, stan@theannuityman.com. But one thing I want you to do above my head is a video talking about the commoditization of annuities. Annuities are commodities. Annuities are commodities. You shop all carriers for the highest contractual guarantee. Then we look at the rating. Then we look for my recommendation. That's the trifecta of wonderfulness in annuities. That's it. Highest number, rating, Stan's recommendation. That's how easy it is. Okay? Hope this helped. Hope this put everything in perspective, because that foundation needs to be there so you can make a very good decision on your terms and on your time frame. My name is Stan the Annuity Man. See you next time.